We've just come off the worst week in the S&P in 2025 so far, and investors are now very fearful, in fact in extreme fear, something we've seen now for the last few weeks, worried about the shorter term with investor sentiment hitting rock bottom. Now when we take a look at how the markets have performed, the Nasdaq 100 is now in a correction territory, and the main reason for this is we are getting a lot of sell-off in the tech space, and in fact Nvidia itself has lost more than 1/5 of its value and responsible for 18% of the index's overall decline, and a correction is defined when we get to see a 10% or more drop from all-time highs. We also noticed that Donald Trump, when asked about the performance of the stock market, he said that he's not even looking at that when he's making his own decisions, so we could go even further down into negative territory. However, he does believe over the longer term, tariffs will make the US stronger, and he blames the sell-off that we have seen on globalists. Now, we did get to see the S&P close a little bit higher on Friday, but not only is it the worst week, in fact, in 2025, but it goes as far back as to September since we have seen a worse performance. Now, Bank of America, as we have highlighted before, believe the S&P is due for a large correction at some point. They warn it could be as much as 40%, and maybe the drop we are seeing is potentially the beginning. Now, whilst Goldman Sachs do offer a similar view, not as aggressive, they just say that global stocks in 2025 are fairly vulnerable. What they put this down to, in essence, is that we have seen a very powerful rally over the last few years as well as over the last few months, but they believe right now they are priced in for perfection. So if we do get any internal factors from the company, whether that's their earnings or anything as such, or if in fact we get any external movement like we are seeing with tariffs and the wider economy, then the share prices will get hit, something we have seen over the recent period. And we are noticing a lot of companies now moving in from perhaps very red territory here, which does highlight companies trading well above their historical forward valuations, coming in slightly nearer, but still a lot of red, meaning many companies like the Apples, like the Teslas, like the Broadcoms are trading at very high valuations. So even though we are looking at a possible correction, we could just be reverting back to the norm. Now, in terms of actual forecasts for 2025, we have previously mentioned that Goldman Sachs believe we will only see around a 10% gain in the S&P. Also, bear in mind this is total return, so including dividends, with an estimation of earnings to increase by around 11% and a slowdown in 2026 to the 7% point. Now, I know a lot of people love Tom Lee. He is a CNBC analyst. He does offer a very similar view. He says a full-year gain will come in at roughly 9.4%, but he does believe we will get a summer rally taking us up to around 16%, 7,000 points on the index, only to come down to around 6,600. Now, the main reason for the episode today is that the S&P 500 does typically look to be the best bet for many investors. Over around a 20-year period, you are looking at an 8.2% gain year on year, but many investors who do like to play their own game, as we can see the average investor picking individual companies, buying and selling, do tend to massively underperform, and that is even an underperformance against inflation, which has come in at 2.2% for the selected period. So today we're looking at 8 stocks that we do believe right now are a sell, at a bare minimum definitely a hold and not a buy. We're going to discuss why we believe that for each company, also running through our own valuation, discussing what we see as the intrinsic fair price, discussing the margin of safety, if any, most of them have none in fact, and the upside or downside that Wall Street see respectively for each one. And the reason we're covering this, as we mentioned earlier, average investors do massively underperform, so we want to let you know why we believe these are overvalued, as there are many great opportunities in the market right now, which we do typically cover on this channel. So the first one is the tobacco giant Altria Group, which has had an incredible performance over the last year, up 39%, year to date also up 11%, but over the last 10 years they have massively underperformed the S&P. They're up only 12%. Even if you included the dividends reinvested, they still would have underperformed, and right now they are trading at their 52-week high thereabouts, with only one buy rating from Seeking Alpha, and they do, as they are typically known for, pay a very high yield of around 7.2%. Now, if we take a look at their earnings, something we always like to do, over the next 4 quarters, they do anticipate growth around the mid-single digit point, whilst over the last 4 quarters, they have outperformed or been in line in 3 of them, 75% track record, gives us faith that they should be able to hit their 2025 EPS target, meaning right now they are trading at a forward valuation of 10.82, which we then like to compare against the sector median. Now, valuation grade, they do get an A+. They're trading below the sector median at 16.6. So right now, you are getting a 36% discount to the overall sector. However, do bear in mind, this company has historically traded at around 9.6, meaning right now it does trade 12% above their own historical figures. Now, do they deserve a discount to the overall sector? The answer here looks like they should be trading at a discount given their growth. Year on year, pretty much flat. Over the next 12 months, anticipated to be flat, when the sector median is at least positive, even though it is low single digit, and the same to be said for their own historical 5-year average. And we do also note, over the next 3 to 5 years, they're anticipated to grow their EPS at 4.3%, when the sector does look a lot higher at 7.7, and their own 5-year is a little bit above at 4.74. Then we want to take you to their profitability, which does look very strong at an A+. Gross margin, 70%, well above the sector at 36%, above their own 5-year at 67%. Their bottom line, 55%, well above sector again, as well as their own 5-year. So we do note efficiencies. They are improving their margins, whilst their revenues are struggling. And cash from operations, quite significant, just under 9 billion, when the sector in comparison sits at 807 million, and their own 5-year a little bit lower at 8.55. Now, the other thing that we want to do is run through a valuation model, not our own one. We will get to that shortly. And always remember, we're not looking at this in pure isolation, but the blue tunnel here is the expected fair price. And right now, what we see is this company, a bit of disparity between where it sits and the upper end. This is one signal here of severe overvaluation. Another signal here is that, as we highlighted earlier, the company does trade at a higher forward PE than their historical 5-year. That is an overvaluation. So is here as well when we look at dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year. We actually notice the opposite effect. The yield on offer is 7.06, below the 5-year of 8.16. That is, again, another overvaluation signal. So putting this through our valuation model for Altria today, we get an intrinsic price of $55 derived from these 3 models, so just purely the average. And typically on this channel, we do run through every single valuation, talking about the inputs as well as the outputs. Today, getting straight through it, we've got 8 stocks to cover. $55. Now, this has no margin of safety given the current price sits above at $58. Typically, what we would do on the channel is add a 10% MOS, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. So for Altria Group, what we're saying right now is you're not getting a 10% MOS, and that would be around $49. For those that would want 15, a buy at 47, and those who would want 20, a buy at 44. So right now, we see this company trading at a premium, one that we wouldn't expect to pay for a company in the tobacco industry, but Wall Street also agree they do not see this at a buy. In fact, over the next year, they see this company trading lower at $55, indicating downside from now at 5%. But as always, give us your thoughts. Maybe you agree, maybe you disagree and believe they're a buy, or maybe just a hold. Now, before we move to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab another recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to stock number 2, that is IBM, International Business Machine Corporation, up 33% over the last year. Year to date, they're up a massive 20%, and over the last 10 years, they have massively underperformed the S&P up 70%. Right now, similar to what we saw at Ultra Group, they are trading near their 52-week high with only one buy rating, although fairly weak at 3.57 from Wall Street, with a dividend on offer at 2.69%. If we take a look at their earnings, they do anticipate growth 3 of the next 4 quarters, whilst also having a 100% historical track record, and right now trade at a forward valuation of 24.4. If we take a look at their grading, they get a D. What this essentially is showing us, right now the company does trade above the sector, so you are paying a 4.5% premium. But not only that, if you look at where they've been trading for on average over the last 5 years at a forward P of 14.8, right now it does sit 56% above. In terms of growth, they get another very poor rating at an F. Year on year, 1.4%. Over the next 12 months, 3.2%. Well below the sector at the mid-single digit on both comparisons, and below on the first year on year at 4%, but a little bit higher than their historical of 0.35. If we then also look at the EPS over the next 3 to 5 years, they're anticipated to grow at 7.5%. The sector significantly above at 15%, but they're not too far off their own historicals of 7.14, which is interesting. They're expected to grow their earnings per share pretty much around a similar number as the last 5 years, but they're trading significantly above how they've been valued on average. In terms of profitability, they do get an A+. Now, gross margin 57%, above the sector at 50%, above their 5-year at 52%. Bottom line, 9.6, above, again, both comparables at 3.9 and 8.6. And in terms of cash generated from operations, 13.5 billion, well above the sector at 109, but a little bit lower than their historicals of 13.8. If we then take a look at the valuation, we get that overvaluation signal already. Massive disparity between their expected fair price and where the company sits, but it does look like a company that has been severely overvalued over the last 12 months. In terms of looking at their forward PE, we've already highlighted right now not only trading well above their historical average, but in fact the highest they have traded for over the last 5 years, whilst also offering the lowest dividend as well at 2.55 when their 5-year average has been 4.8. Now, in terms of our valuation, we get to $248, and as we can already see, a very similar thing that we noted with Ultra Group, the current price does sit above at $261, meaning no margin of safety. We see this trading at a premium. For those that did want 10%, a buy at $223, and at 20%, a buy at $198. And don't forget, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for IBM or any others. Wall Street themselves, they see this company trading at the same price it is today in the next year. That means no upside at all. And as always, do let us know your thoughts below. We then move on to Starbucks, which is up 17% over the last year. Year to date, up 17% too. And over the last 10 years, up 128%, underperforming the S&P, whilst trading near the upper end of the 52-week range, and just 1 week rating of a buy again from Wall Street. And they do pay dividends, sitting at 2.31%. Now, in terms of their earnings expectations, they expect 2 of the next 4 to be growth, although the first and upcoming 2 to be a negative on the EPS, whilst also outperforming or at least being in line for only 2 of the previous 4, 50% track record, and they do currently trade at a fairly high forward valuation of 36.1. In terms of their grading, probably no surprises then that they do get a D-. They are trading well above the sector. In fact, you're paying a 130% premium. And we do notice, though, in terms of their last 5 years, they pretty much are valued at the same level. In terms of growth, not looking too good at a D. Revenue year on year, negative 1.5%. Forward looking 4%. We do see the sector looking not that far off on both accounts, but over the last 5 years, they have grown at a much faster rate on their revenue at the mid to high single digit level. And in terms of the EPS, expected to grow at 8.4%. That is below both sector at 11.2, as well as being lower than their own 5-year at 14.7. So they've been growing at a faster rate over the last 5 years, whilst also right now being valued at the same level. In terms of profitability, they get an A. Now, gross margin, 26%, much lower than the sector at 38%, pretty much in line with their historicals. Bottom line, 10%. We notice the sector does sit lower at 4.2%, whilst the last 5 years just a little bit higher at 10.2%. And cash generated from operations, quite significant, 5.8 billion, sector 286 million, and their own 5 years sitting lower at 4.7. In terms of looking at the valuation, again, the continuous theme of an overvaluation signal. We do see disparity between the upper end here, something that is reconfirmed when we take a look at their valuation against their 5 years, trading at a higher level, but we do notice their dividend yield does sit a little bit higher at 2.29, above their historicals of 2.16. So let's get to the valuation of Starbucks, where our intrinsic value is $90, maybe the largest one so far in terms of trading at a premium. The current value is 107, our intrinsic at 90, quite a substantial difference, but for those that did want to see, at 10% a buy at $81 and at 20% around 72, and that is a price we have seen over the last few years. So trading at a massive premium, Wall Street, whilst they did get that buy rating and they do see upside, their projected price in the next year is $111. That is a very mediocre 4%. And if you are someone that does like to listen to the analysts, they're effectively saying the S&P 500 is going to outperform this over the next year with around a 10% gain. We then move on to the Hershey company, which is down 4% over the last year. Year to date, up nearly 10%. Over the last 10 years, massive underperformance of the S&P, up only 85%, and we can in fact see all-time highs around $275. We're talking nearly 2 years ago. Right now, they're trading in the mid to upper end of the 52-week range with just one buy rating from Seeking Alpha, and they do pay a yield of around 3.04%. In terms of their earnings, well, actually, over the next 4 quarters, they expect massive decrease to the EPS. In fact, 3 of them negative double digit, and over the last 4 quarters, they have missed 2, giving them a 50% track record, whilst right now trading at a forward valuation of 30.3. In terms of the grading, they do get a C. Now, they do trade a lot higher than the sector median at 16.6. In fact, you're paying a 77% premium, but they're also trading well above their 5-year at 24. In fact, that is 23% higher. Now, that typically wouldn't be an issue if their growth was very strong, but their growth grade here is an F. Year on year, pretty much flat. Over the next 12 months, expected 2%. Both of them underperforming, although marginally the sector, but massively underperforming their own 5-year at 7 and 6% respectively. Now, EPS, something we haven't seen in quite some time, is expected to decrease nearly 10% over the next 3 to 5 years, with the sector median a positive 8% and their own 5-year a positive 7% too. Profitability coming in at an A. Now, gross margin 47%, sector does sit lower at 36%, as well as their 5-year at 45%, and bottom line 20%, sector at 4% and their 5-year at 16%, meaning they are at least improving on their efficiencies on both a gross margin basis and a net income. And in terms of cash from operations, $2.5 billion, with the sector at $807 million and their own 5-year at 2.1. So when we do take a look at this valuation, again, another signal of overvaluation. Not only disparity here, but what we also want to highlight is that over the last year, their expected fair price has decreased. Not something you really want to note with companies you're invested in. You want over the longer term for them to be worth more. We also notice that their forward P, as highlighted earlier, does sit far above their 5-year average, but one thing we would highlight, based on dividend yield theory, it does look to be potentially undervalued, as the yield does sit significantly higher, 2.96 above 2.13. Now, if we talk about this company's intrinsic price, $203, the first one today where we actually do see a margin of safety at 10%, a buy at 183, so not there yet. We only see 5% MOS for Hershey, but Wall Street, very, very interesting. They see this company at $157 over the next year. That is downside of 17%, and as we said, this is one that we do believe at a bare minimum is a hold, potentially a sell, but most definitely not a buy. Do give us your thoughts though as we do go along. We then move on to AbbVie, which is up 19% over the last year. Year to date, up 21%. Over the last 10 years, this one has in fact the first one to outperform the S&P, up 270%. Trading right now at its 52-week high with a double buy from Seeking Alpha from Wall Street and a yield payable of 3.1%. In terms of their earnings, they expect growth over the next 4 quarters, whilst having a 75% track record, and right now trading at a forward valuation of 17.5, which when we do take a look at the grading, they get a D-. They're pretty much not that far off the sector median, around 4% discount, but they're trading well above their own 5-year, in fact 45% higher. But remember, these things aren't an issue if their growth does look to be promising, which we can see here is actually the opposite. They get a D. Year on year, 4%, Forward looking 6%, sector higher on both accounts at 7.4, 7.1, but the last 5 years also higher at 12 and 8% respectively. Now EPS is expected, however, to outperform both sector as well as 5-year at 12 versus 11 and 4, which is a good sign, but remember they are trading significantly higher than what they were valued over the last 5 years. Profitability comes in at an A+. Now gross margin 70% above the sector at 60, pretty much in line with their 5-year at 70. Bottom line 8%, sector as a whole losing money -4%, and their 5-year however does sit higher at 15.6, and they generate a ton of cash from operations at 19 billion. Again, sector losing money -14, but their own 5-year they have generated more cash at around 20.6 billion. Now we get another overvaluation signal, but one thing we can point out is at least their fair price has been increasing over time, unlike Hershey, but over the last year again we do see this continually trading at a severe overvaluation. As we've already highlighted, their forward P does sit significantly above their 5-year, but they also do pay a yield which is substantially lower than the 5-year at 3.06, when historically it has sat at 4.02. Now our valuation today comes in at $205. Again, there is no margin of safety given the current price does sit at $215, but for those that wanted 10%, a buy at $184, those who wanted 20%, a buy at $164, and we do also notice Wall Street pretty much see this company a little bit lower over the next year at $213, indicating downside of 1%. We then move on to the Kroger company, which is up 20% over the last year to date up 9%. Over the last 10 years, it has massively underperformed the S&P, up 75%, trading pretty much near its 52-week high, and we do get a double buy, although fairly weak, from Seeking Alpha from Wall Street with a yield payable of 2.01%. In terms of earnings, we get pretty much green right across the board, which is always great to see, and they do trade at a forward valuation of just below 14. Now, in terms of comparing it against the sector, they do trade at a discount of around 20%. However, we do note over the last 5 years, they have traded lower by around 10.6. Again, remember that isn't typically an issue if growth does look good, but they get a year-on-year -2%. Forward looking pretty much flat, with both the sector, even though it is low single digit, outperforming, as well as their historical 5-year above at 4 and 3% respectively. In terms of EPS, they're only anticipating growth of 5% when the sector does sit higher at 8 and their own 5-year sitting higher at 7.6. If we take a look at the company's profitability, where they get an A, gross margin 23%, below the sector substantially at 36, their own 5-year pretty much in line at 23, and bottom line very low at 1.81, given the sector sits at 4.4 and their own 5-year sits around the same at 1.52. Cash from operations, 5.8 billion, pretty much in line with their own historical average, but well above the sector comparative at 807 million. In terms of the valuation here, we do get that disparity. It is slightly above, so again, overvaluation has been noted, and we can also see above their own 5-year average, whilst also the yield payable lower than their historicals of 2.15. If we get to our own valuation, we get to $65, with again, no margin of safety. For those that wanted 10%, a buy at 58, at 20% at 52, and we can see Wall Street themselves, they see this at $69 over the next year, only 3% upside. We then move on to DE, Deere & Company, up 33% over the last year to date up 18%. Over the last 10 years, this one has massively outperformed the S&P, up 458%, trading near its 52-week highs with another weak buy rating from Wall Street, and we do notice a yield payable of 1.34%. In terms of earnings, although do bear in mind this is in a cyclical industry, they only expect growth from the next 2 quarters, and they have missed their most recent one, although they've got a 75% track record, right now trading at a valuation of 26.2. In terms of the sector, they are trading at quite a substantial premium of 39%, but also well above their own historical 5-year of 18. You are paying 41% more. And when we take a look at their growth at a D-, year-on-year, -21%, forward-looking, -10%, when the sector, again, does look much better at 4 and 5% respectively, but so does their 5-year at 8 and 6. In terms of EPS, expected growth is 8%, which is lower than both sector at 11.7, but also their own 5-year of 13.3. Profitability does look good at an A+, gross margin 29%, lower than the sector at 32, but pretty much in line with their 5-year at 29. Bottom line, 13% above the sector at 6.3. Again, pretty much in line. Margins have stayed consistent, with cash from operations looking very strong, 9 billion, when the comparable comes in for the sector at 370 million and their own 5-year lower at 7.1. We get that continuation of overvaluation, but we also notice expected fair value decreasing over time. Massive disparity again, severe overvaluation, with the forward PE looking incredibly high at 25.5 when their 5-year sits at 16, and the yield is pretty much the same as what they have historically offered. In terms of our intrinsic price, $470, they're trading now at a substantial premium, but again, 10% MOS, a buy at 422, at 20% 376, and Wall Street themselves see no upside, in fact 1% downside. They see this trading at $494 over the next year, and as we said, no margin of safety. We then move on to the telecom giant AT&T, ticker symbol T, up nearly 60% over the last year, year to date up 20%. Over the last 10 years, however, massive underperformance of the S&P, down 17%, again trading near its 52-week high, with a double buy from seeking alpha on Wall Street and a yield payable of 4.15%. Now, over the next 4 quarters, each one of them expected a decrease to the EPS, with a 100% track record looking backwards, and currently valued on a forward P basis of 12.74. If we take a look at their grading, well, they do trade at a little bit of a discount to the sector by 6%, but if you look at what they were valued over the last 5 years, they do sit right now 53% higher, and in terms of the growth, where they do get an F, year on year flat, over the next 12 months, not even 1%, sector higher although marginally at 2 and 3%, and over the last 5 years, interesting to note, they've actually been negative on both accounts, -2 and -4% respectively. EPS expected to barely grow at 0.63%, with the sector much higher at 12 and their own 5-year only marginally higher at 1.1. Profitability looking good at an A+, gross margin 60%, sector lower at 53, their own 5-year also lower at 56. Bottom line, 9% above both sector at 4 and their own 5-year at 4, meaning we are seeing efficiencies on the margins, whilst cash from operations at 39 billion is a little bit lower than the 5-year at 40, but significantly above the sector at 354 million. We then get to that overvaluation signal that we are getting used to now, with the essential price showing massive disparity to the expected fair value, and we also highlight this on the forward valuation, 13.2 above their own 5-year at 8.3, and dividend yield theory also reconfirming. If we get to our own valuation, we see this at just under $27. Again, no margin of safety, but for those that are interested, at 10%, a buy at $24, at 20%, a buy at $21. Wall Street themselves, whilst they do see upside over the next year at $27.65 target price, this only translates to 2%, and therefore, like the previous stocks, we do believe there are many better options, which we do typically cover on this channel. As always though, do give us your thoughts about these 8 stocks we have covered today. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon, where we do cover our weekly buys and sells. We have been buying over the last few weeks, given a lot of volatility, and as always, have a great day, and we'll see you all on the next one.